Bruce, a lot of hopes swirling around a rate cut. Do we get one with an ISM services number like this?
Well, I don't think we get one in June. Our view is that what's happening on the trade conflict front is going to hit the economy, among some other things, and that we're going to see enough slowing and enough concern to get the Fed to be easing later this summer. We think in September we're going to get a Fed ease.
How are they going to frame that pivot? What are they going to use as reasons for their change?
Well, I think
because yesterday a lot of the commentary said we can look through tariffs.
Well, I think they can look through tariffs as long as the economy is holding up. But what we're expecting is growth over the next couple of quarters to slow to a below 1.5% pace, job growth to slow towards 100,000. I think against that backdrop and with the trade conflict still going on, that's the recipe to get you a Fed cut.
You think ADP is a canary in that coal mine?
I've never been a big fan of the ADP in predicting Friday's number, but I think it is qualitatively sending the right signal that job growth is slowing. We've got a 160,000 forecast for Friday. And again, we're looking for job growth to slow to about 100,000 per month in the third quarter.
All right. Paul, are you in this same camp that we are seeing signs of slowing and that as the pain persists, the Fed will move?
Yeah, the pain is definitely showing up more, and it's definitely attributable to tariffs and trade around the world and how that impacts business spending. It's not clear to us yet that we are going to get a Fed rate cut or even when that might happen. There are some signs of strength still in the economy. You saw that in the services number this morning. And frankly, you know, a lot of us remember back to 2016 when there was a lot of hand-wringing about Fed policy not being effective. Well, what you really needed at that time was a boost to aggregate demand, a boost to spending around the world. The Chinese came through with some massive stimulus. That may not be in the cards quite yet. And until that happens, you might not get the sort of bang for the buck that you would expect from a Fed rate cut.
Yeah, the Chinese may be under some pressure in their economy. Do they have the wherewithal to actually do what you're suggesting if, in fact, they feel like it's necessary?
They do have the wherewithal, it's just that they really don't want to do it because it just throws more wood onto that great big pile of kindling that is Chinese debt. So they're really trying to use a variety of other stimulus measures right now, tax cuts and other things that we're used to seeing in this country, but that aren't probably very effective in China over the longer run, certainly not if tariffs continue to escalate. So at some point, they may have to reach back into their tool belt and pick up some bigger hammers to hit the economy with to get it going again. They don't really want to do that, but the delay between now and the time that they feel forced to do that could be material for investors.
Bruce, JPM had a piece yesterday saying if all the tariffs go through and if you assume full pass-through to consumers, it would hurt household purchasing power by almost $300 billion, double the effect of the December 2017 tax cut. Is that the base case?
No, that's not our base case, but I think it's important to recognize that this is the magnitude of what would happen if we got all of the tariffs that are being threatened. I think equally important, the big call on the tariffs is the indirect effects, which we've already been seeing in terms of business confidence and business spending slow. The idea that we're changing the rules of the game in terms of the global trading system, the way it could affect supply chains in North America, the way it's already affecting supply chains in Asia, that's really the big call here in terms of the risks to global growth.
Yeah, I think we've been having this discussion a lot. We understand why it would create uncertainty for the enterprise, for supply chain managers, but how does that hop? How does that make the leap to the consumer? Are we seeing that yet? Would you expect to see that sometime soon?
Well, I don't think we're seeing it yet, and I think the point that there is still strength in the economy and the consumer is a big part of it is right. But part of it will come from higher prices if the tariffs go up. But the bigger part will be the pullback in business spending that starts to hit the labor market. That's really the call. We've been thinking that the labor market will not get hit too hard because the business sector will be holding up in the face of what is still pretty good fundamentals. But we start to throw more tariffs on the system, more uncertainty. You have to worry that that's not going to hold quite as well. And that's what our change in the Fed forecast is about, that there's more of a hit to job growth as we go through the next few months.
Paul, you think you agree? Do you think business can withstand tariffs continuing to rise both against China and Mexico?
No, they can't. And they've made adjustments during the last year, maybe with the idea or the thinking that the tariffs were a negotiating ploy or would be temporary. But if the mindset changes to the view that, well, gee, maybe these tariffs are going to be lasting longer than we thought, or perhaps even permanent, then the supply chain rethink has to take a higher priority. And that's when you begin to see higher cost in moving those supply chains and potentially even higher production costs as you move to countries with higher wages than China. So it's not entirely clear that you can see those impacts right away, but we think they'll build, especially if you see new and additional tariffs.
Bruce, corporate credit, high yield spreads prior to yesterday. How much of that is on your radar, and how much of it depends on the price of crude?
I think corporate credit's a pretty big issue here. We have a lot of leverage outstanding. If we really wanted to worry about recession risk, which, by the way, isn't our call here, I think you'd need to have a credit story as part of it. Spreads have widened, but I think credit is still flowing pretty well. The backdrop for corporate fundamentals is still good. It's not our concern right now, but it's certainly something to keep an eye on.